Okay, welcome. Thank you for joining me on this Saturday morning. Thank you for taking time out of your day to come and listen to me yap away a bit about common retail trader habits and what to do about them. My name is Justin Paolini, trading performance coach here at Building a Trader, and I'm going to try and keep this presentation short and sweet so that you can all get back to your weekend. Before we start, let's just read the risk warning. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit, so before trading, please carefully consider the risks and the entering costs and seek independent advice as required. Please contact us to discuss any questions or concerns you may have because we are here to help. And with that said and done, let me introduce Building a Trader. Building a Trader is my humble hut. Many of you know me from past businesses. I've been in the trading education sector for a while. I've been a retail trader for most of my career, and then recently I graduated onto the institutional side. I've sent analysis and trading signals to institutional clients, and I'm currently head of trader development at a regulated broker in the UK. So why set up Building a Trader? Why set up my own little site? Because I firmly believe in a very precise pathway to take traders from being struggling retail traders to being consistent professional traders. So this is my pathway. The premise for all of this is that there really is a ton of information disseminated across the internet. There's more than 10,000 books on trading that have been published, including my own. I'm also in there. But despite all of this information, most traders lose money and they tend to fight trends. So this is just a chart of the euro dollar. This is taken from my FX book Outlook, and it shows the aggregate positioning of retail traders as the market goes on along its business. And you can notice that the majority of traders have been net short on the euro this year, because this is starting in January 2020, when the euro has been basically rising. Recently, it's gone lateral, but still, for most of the year, the euro has gone up, and that's just showing you how bad most traders are because they kept fighting this trend. So, what is the pathway? What I want to do is I want to attract passionate traders like yourselves that have passion for the markets, time to dedicate to this adventure, and enough capital to open a small account and to concentrate on building a performance on a small account. I can also help traders that already have their own track record, that already have their own system, because it's just a matter of focusing on what's working, eliminating what's not working, and working towards certain goals, working towards the trader's strengths in order to produce the kind of risk-adjusted returns that we need in order to achieve funding. And this is done through coaching. So whether you have a system or not, the two pathways converge here towards coaching, because in my experience, one-on-one coaching, actually interacting with an experienced professional, is really the only way to shortcut through all of the garbage, all of the misinformation, all of the other practices that are out there on the internet and that lead to dead ends. And through coaching, we will build successful habits, we will remove strongholds, and we will measure performance consistently in order to achieve the kind of metrics that I know are required in order to achieve funding through my partners at FCI Markets. So it's a very straightforward process. This is what my business is about. This is why we're here today, because I know that capitalization is one of the biggest issues for traders. And I want you to know that capital is always available to traders that can trade consistently and that can deliver decent risk-adjusted returns. And through FCI, the funding opportunities start very low. Okay, it's very flexible. Don't think you're going to be managing 250,000, 500,000 pounds, just off the bat. You will grow, your allocation will grow, but you can achieve up to 1 million pounds real money, through this funding process. The difference between this funding process and other processes out there is that there are no extra costs. You just get in on merit. The allocations are reviewed every 3 months, and your payout is dependent on your performance metrics. Okay. So prop shops are popping up everywhere. Okay. Now I know that there are all sorts of other educators out there that are saying, look, come through me and I'll get you funded through this prop shop, or you can achieve a certain amount of buying power. Okay. The reality is that, to me personally, it's not worth paying in order to sit at a desk and trade somebody else's money if you already know how to trade. Okay, if you know how to trade, then just seek funding possibilities. It really isn't worth paying to sit on a desk, because a lot of these prop shops that have been popping up don't even send you to market. If you read through the terms and conditions, what you'll notice is that they actually keep you on a demo. Not all of them, but some of them keep you on a demo, and they give you access to profits if you make any. But the other thing is that a lot of these prop shops come with restrictions. You can only trade intraday, or you can't hold over the weekend. You can't hold during certain news events. You can't trade during news events. So with all these restrictions on how you're supposed to trade, how you can trade, etc., it's just it's ridiculous. You are severely limited in what you can do. And the pathway that I've set up isn't like that. I mean, the pathway that takes you through funding at FCI Markets is just about you learning how to trade. Once you can deliver risk-adjusted performance metrics that we like, then you can access capital and trade your way. End of story. Now, the other thing here about the building a trader pathway is that you end up, after your coaching process, into a room with like-minded traders that have all the same objective, and that allows you to network as well. So after this brief introduction, let's get on to inverting common retail trader habits. Now, I've spoken a lot about this. I've done a series of educational webinars over at FCI Markets. Now, I would encourage you to go over there and check them out, especially this Trader Foundations playlist on YouTube and the Healthy Trading Habits playlist on YouTube. Okay, I put a lot of effort into these educational webinars, and there's a lot in there. So today we're just going to confront one very precise aspect of what retail traders do and how we can invert those practices. Okay, but go over here to FCA Markets YouTube channel and check out these other webinars. What we need to tackle, what we need to understand, is that most traders don't know the truth about trading, and they don't have quality information, and they need that. The second thing is that traders need to think about risk-adjusted performance and not about money. Anytime traders are under pressure to perform, they can't do it. Okay, and this is the same for retail traders and for professionals alike. If you need to trade for money, you can't trade. The third thing, and this is one thing we're going to talk about today, you need to get specific with your approach. Too many times I've seen traders take in all sorts of information, but fail to absorb, digest, and actually put that information into practice. What happens instead is they take on bits and bobs here and there, but they never elaborate that into a proper strategy. Through experience, what I've noticed is that traders don't know how to read trending markets like professionals do. And the truth is that the easiest, I shouldn't say easiest, I should say simplest profits are made in trending markets. That's when a lot of the different entry techniques that traders focus on will actually work, because the market's already trending. But traders just fail to do that, and they fight trends we've seen in the screenshot before. And finally, traders need to become independent thinkers and not try to copy others. Okay, these are the hard things to do for most people, but traders need to do it if they want to become consistent and if they want to achieve funding and trade other people's money and not their own. Okay, so let's get practical and go into some examples here. This is what coaching can really do for you, because this is the equity curve of a trader that came to me. This is 2 years ago, and this was his equity curve. So basically he ended up being a losing trader up to a certain amount of time. Enormous leverage being used here, lack of consistency. He gave it all back and more. So he asked for help, and this is why I'm here. I love to help people that are doing this, because even though I've never blown an account, I know what it's like to be going around in circles. I know what it's like to not make any progress and not even know why you're not able to make any headway. So fast forward, this trader's been working with me on and off for a couple of years. He's been working with me more intensely since I opened Building a Trader. And this is now his equity curve. And what I want you to see isn't just the fact that he's making money, but what I want you to notice is how initially the drawdowns were quite big, and gradually they're getting smaller and smaller and smaller. So in reality, his risk-adjusted performance is going up tremendously. Okay, because he's really learning how to pick his spots. He's learning not to risk his capital in the markets each and every day. He's learning to be a professional, because when somebody gives you 250, 500, 700,000 pounds, they're not interested in 20% returns per year, 30% returns, or 50% returns. They don't care. What they care about is that they will have that money at the end of the year and maybe some more. So whether you make 5%, 10%, 15%, that doesn't really matter. It's how much you risked in order to make that. Because if you made 50%, but at the same time you risked 50% of the account, your risk-adjusted performance isn't very good. So instead, if you're able to achieve, let's say 10 or 15% on that money, but risking 2 or 3%, your risk-adjusted performance is fantastic. And the people that have funded you know that in no case will you actually blow up their account. And that is the key here. This is what we're talking about. So what kind of metrics do I measure, and do I help traders gain an awareness about in order to get on the path to victory? Well, this is the rolling average profit to average loss ratio of this trader. Okay, so the average profit and average loss are part of the expectancy equation, and it's important to know where you stand, because it doesn't matter if you have a 90% win rate if your profits are just a fraction of your losses. Okay, because that means that your entire profitability hinges on your win rate, and that is not the place you want to be. Okay, we'll see why in a bit. I have a slide on that. But what I want you to see is that, working together, this trader has been gradually raising his average profit to average loss. Now, it's not good enough yet. Okay, it should be at 2 or better. But what I want you to see is the progress. Okay, this trader is literally turning his trading around. Okay, this is an excellent curve that he's following. Okay, and his Sharpe ratio needs to become less volatile, but especially in the recent past, he is starting to diminish the volatility and increase the consistency of his returns. Okay, and again, the Sharpe ratio needs to be at least 1. It should be 1.5. Okay, but he's getting there. Okay, what I want you to see is that there is progress being made. But I'd like you to wonder, where would he be if we weren't working together? And these are just a couple of issues that we worked through. These are mindset issues, not just technical issues, but the mindset issues can really hold you back in your trading. Of course, like many of us, he has a small account. Okay, and this is why trading your own capital is a bad trade, because he was always thinking about, the fact that he's trading peanuts. It's ridiculous. I need to make big money. I need to make an income from my trading. Sure, but if you have a small account, you're going to be over leveraging it, and you're going to be putting a ton of pressure on yourself. And so that's why here with building a trader with me, the focus is on the actual performance metrics, because the money is always there. You have funding available. All you need to do is be consistent and focus on your percentage returns and on your risk-adjusted returns. And we also have to stop system hunting. So, talking about inverting retail trader bad habits, it's not just about the money, it's about the system too. Too many traders search for the holy grail system. They want something that will work all the time. Or they scan social media for profitable traders to copy. And in doing so, they doubt their own research. They doubt their own work. They also, they have fear of the unknown unknowns. Do I know enough? Is there something I don't know that I need to know? Is there something that will work most of the time? And always trying to find this stuff. And of course, if you look on Twitter or on social media or Instagram especially, everybody posts the trades that they win. Nobody posts the trades they lose. Okay, so you're constantly bombarded by these false promises, and it works against you, because it just reinforces the self-doubt and the fear of unknown unknowns. It's terrible. And the other thing is that most traders have no patience. It's all about short-term gain, and of course always about the money, right? So nobody is thinking about stacking the odds. They're always thinking about the short-term gains and just risking money and taking the next trade, et cetera, et cetera. So from a personal perspective, I think the one thing that I really try to fix here building a trader is the fact that since I've probably been through everything twice, I made all the mistakes in the book at least twice. I've probably seen most of what's out there, and I can help you avoid all these dead ends and help you gain confidence that what you're actually doing is sound. And here's something that I just wanted to show you. A lot of traders out there, they play this sort of demand supply kind of thing, and or liquidity spikes or whatever. And this is just one example of a chart I saw. So there was some kind of a news or liquidity spike down here on the euro, and this trader was saying, okay, well, when we get back down there, it's a great place to buy. And in reality, there really is no concept of trendiness. There is no concept of swing highs, swing lows, key levels, etc. The guy's just saying, if it gets down here, then there's a buying opportunity for whatever reason. And independently from the lack of consistency in the actual entry approach, because there really was no consistency in the entry approach. It was just basically, when price gets back down there, look what it does, and then use whatever you want to get aboard, etc. But the fact is that it doesn't teach you anything about how to read the market on the way down. What context are we actually in? What are the fundamentals? What's happening? Okay, so when you build an actual system, what you need to have is a process that guides you towards what instruments you put on your watch list and what are the best looking pairs. How do you actually rank your pairs? Okay, so which ones are decisively long, which ones are decisively short, and which ones instead are flat, so you just put them away, don't look at them. What is the setup? What is that repetitive behavioral trait in the market that actually alerts you to a trading opportunity? What is the trigger? What gets you aboard? What is your position size? Okay, and then how are you going to manage the trade? If you do not have this whole process in place, you will be an emotional trader, and that's not a good place to be. And why do you need proper trade management? Why do you need to try and trade those trends and run your profits? Because you need to not care about whether the next trade is going to be a winner or a loser. Okay, The reality is that if you need to be right, there's a ton of pressure on you. There is no room for losses. And of course, you need to be right. So it's a vicious circle. Okay, what you need to do instead is make sure that your profits are 2 or 3 times at least your losses on average, because you have less pressure and because you know that one win will take care of more than one loss. Okay, so this is how you put the math in your favor as a trader. Only trade when you have a superior risk-adjusted reward that can potentially be obtained. Never certain, always potential, but it should be there. So to help you do this, here is the one key concept that we're going to look at today. And this came up recently in our in the live chat room. How to read trending markets like a pro, okay, and not get confused. This is an hourly chart of the euro in recent past. Now we're going to follow this chart and we're going to learn where the market is actually turning around, so when the direction changes, and if we're still trading in the same direction, where the market stalls and goes into neutral. So starting from the 27th of October, so just a couple of weeks ago, the market was on the hourly chart. Of course, the trend had formed a range. Okay, so lower low, higher highs, lower lows, etc. And then this range was broken to the downside. So obviously, the direction is short. When in this context, where is it that the direction would change to long? I think it's pretty evident above the range top. This most recent evident high up here is what needs to hold on any retracement in order to keep the market in its current downwards bias. So let's move on. Okay, let's see as this thing continues what the key levels are. So the market broke through now into the next week. We can see the market broke through support, but let's focus on the trending process. Okay, so you have the high, then you have the lower low, and then you have during the day, you have these lower highs and then lower low. Okay, so when you get down here and even into the end of the day, since nothing else changed, the level, the most recent lower high on your hourly chart, okay, most recent lower high that produced a lower low, is the invalidation level. This is where, if the market starts to print higher highs and lows above this, this is where the actual bias will change. Before the market gets up here, however, it can actually go into neutral and not change the bias. So basically, right now, in this context, we're still short. We're still holding our shorts because what we did here is we retraced and we're stalling out a little bit, but we didn't print a higher low, higher high that would stall price action because we would violate the most recent lower high here. Okay, so we're still short, waiting to see what happens. This is the invalidation point. The market consolidates, as you can see. Okay, so it doesn't get above its invalidation point, so it's still short, and it went into a range on the hourly chart. And then it breaks through the range, so you can add to the position, for example, on something like this. And this is your next lower high. And it comes down, 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 down. Now look what it does here. Okay, it starts to pull back. Okay, it makes this sort of consolidation ledge, and then it makes higher high. So now you're neutral on this pair. Okay, if you're trading the trend. If you're not trading the trend, you're trading a range, and you know that this is the range top and this is the range bottom. So if you're going to trade in the direction of the bias, then you're going to look for pullbacks more or less to this area here, which should hold. Otherwise, the market will definitely start to move slightly up, and you really need to stay still. And what did the market do? It came up and it faked out the top of the range, got back down to the bottom of the range. So now, the most recent lower high is here. This is your invalidation point. So if the market gets back above there, you're long. As long as it stays below there, you're short or flat. This is how the market continued into the next day. It remained basically range bound. Then it printed a lower low. It printed a marginally lower high and a marginally lower low. So that is your most recent lower high. That then is the invalidation point. And the market goes up and it breaks it. Okay, it actually breaks and it comes back down below, so it fakes it out. There's a range forming when it does this. So automatically you know that down here near the lows is where buyers might appear this time, and you know that this is a range, so caution is required. The next day what happens is the market from this range starts to build a little bit of a base, consolidates around the range top, and breaks through. So now you're long. Very simple. It really is very simple. Okay, these invalidation levels really help you generate your bias. So now you switch from short to long. The market continues to go up, and now the most recent higher low is here. We haven't printed a higher high yet, so this is simply the point in time where you would get to neutral. So if the market came back down and broke through it, you'd be neutral. You wouldn't be short because this is your invalidation level. So you just be neutral, waiting for the market to start to print the higher low, higher high step to get you back long. This is election day. And as you can see, the market printed a higher high. So that was your invalidation point that kicks you into neutral. And down here, of course, is where you would actually flip to a short. Now the election generated a lot of volatility. So from way up here, it went all the way back down. But after printing the lower low, it printed a lower high, but then it printed a higher low. So it's not following through. The trend hasn't changed. So you're neutral. You're neutral in a situation like this, waiting for more information. Now the market at this point in time has basically the high up here, the low down here. So within this range, no decision making is to be done. But you can see that it's building a base, higher low, consolidation near the highs, and this gives you a bit of information. And the next day what happens is that it prints higher low, during Asia. Into London, it's pressing near the highs. So, the most probable direction is up. This is your current invalidation point as the day is closing. This is the most recent higher low, which is the area where you'd kick into neutral. So once again, let's see what happens. The higher low holds and the market continues on its way up. This is the most recent higher low. Okay, and into the next day, a bit of a range-bound behavior. The market tries to make these lows, and then it makes a lower low. So we're in range-bound mode. The highs are faded, and then it comes back down. So we were into neutral as this day was printing. Okay, into neutral. As the day closes, we're basically switching into a short position, and below here we would definitely be short. And what happens is the market continues to trade in the range, then it breaks down short. It doesn't get very far, but it breaks down short. At least we know what our direction is. Prints a lower high, and I think this is the end. I don't think I went any further. Oh no, I did go further. So here's the most recent lower high. It held overnight, and the market continues to print lower prices. And so as of yesterday, this was the point in time where the market would actually flip to a long stance. And at this moment in time, with this kind of performance, that's the only area that actually matters. So, on the euro, you're short below there, and you're waiting to see what the lower highs, lower lows, or higher lows, whatever the market does in terms of printing the cycles, will alert you to whether you're flat or still short. This is very simple. It's a very simple way of reading the markets, reading the trends. It keeps you on the right side of the market. You can use it on any time frame. You can use a combination of time frames even. Okay. Oh, there was one more. So we're neutral. Okay, let's go back to here. So the exercise is, sorry, I have a little thing. The exercise here is to practice, laying out your trend chart map as illustrated here prior to each day's open. Okay, so you always know the levels that are required to maintain the dominant bias. Those are those yellow invalidation levels, as well as the levels that will turn the market into neutral, kicking it out of trending gear. So basically, if a lower high or a higher low is taken, but the key invalidation area is not invalidated, then you're still in the trend, but you're neutral. This little exercise will really help you to solidify your intraday decision-making process, and it'll really shine a spotlight on the areas to focus your attention on going forward. Because you noticed, if I just scroll up a little bit, you noticed how often these little areas are where the market does make a decision. Okay, from the day, for example, from the day before, this was the most recent lower high, and that is where the market would kick into neutral if it gets above it. So that is where, for example, buyers should try to come back in to smack the thing back down, and it goes into a range, but that is the level that holds. That's the level that gets traded, and the market is pushed down. That's the most recent lower high. That's the level that gets traded. Okay, and then when the market printed this lower high into the 12th, it printed a higher low. When it broke the lower high, the market's into neutral. So, we're not long because the key invalidation area has not been overtaken, but we're not short because we're not printing the lower highs, lower lows anymore. Okay, so this is a case where we're neutral. What do we need in order to get out of this neutral case? Well, we need price to at least break back down through this, lower high area. So it's a really simple process based on market structure. There's no ifs, ands, or buts. Okay, there's no discretion. That's just the way it is. Now, I would encourage you to do this exercise for yourself, and I would encourage you to send me your work, okay? Because I'm here for you. I'm here to help. So send me your work, and I'll give you the email in just a bit. Okay, send me your work at hello@buildingatrader.com. Okay, because I really want to help you. I want to help you to simplify your trading, and this is one of the main practices that is simple but subtle. It's a simple practice that gives you a lot of clarity, and it'll give you, many ideas on how you can trade the cycles and trade the trends on whatever time frame you're using. Okay, and if you just show me your work, I'll give you some pointers, and hopefully that's all you need in order to become consistent, and you'll come back with a nice track record, and I'll be able to help you get funded. But instead, if you need more help, or if you think we could work together, then come on over to buildingatrader.com and go to the coaching assessment. I don't take on everyone as a student because I want to make sure you actually have a fighting chance. So I want to make sure you have a bit of time to dedicate to the markets. I want to know you have at least a bit of risk capital that you can throw into the market and generate a track record. I also want to know more about your background. So it's a little assessment. It's free, no obligation. Just go to buildingatrader.com/coaching-assessment, fill it out, and you'll be able to download the Word document, and then you just send it back to me. Really simple, and immediately we'll know if we can work together, and I can give you some pointers if I think that we might not be a good fit, but at least I won't leave you empty-handed, because my objective here is to help you avoid the kind of hardship and frustration that I went through at the beginning of my career. And that's what I hope I'm able to do. I hope I'm able to help. Well then, I look forward to seeing your exercises, okay, and seeing your practice on this little nuance that we've looked at today. And If you're not subscribed to Building a Trader yet, all you have to do is send your exercises to hello@buildingatrader.com. I'll take a look at them anyway and give you some feedback. I'm going to thank you all for taking time out of your weekend to come here. I tried to keep this short as possible. I know we've gone on for an hour anyway. Such is life. But yeah, it's an honor to be here helping you out. And I look forward to seeing you inside the live coaching room. So enjoy your weekend. And thanks again for coming. This is Justin Paolini from Building a Trader. Over and out.